I will review sensitivity analysis as a tool for capital budgeting. Capital budgeting involves choosing projects that add value to a company. The process can involve nearly anything, including obtaining land or buying fixed assets like a new truck or machinery. Companies use different metrics to track the performance of a potential project, and there are various methods to capital budgeting. The three most common approaches to project selection are payback period, internal rate of return, and net present value. The payback period determines how long it would take a company to see enough in cash flows to recover the original investment. The internal rate of return is expected return on a project. If the rate is higher than the cost of capital, it is a good project. The net present value shows how profitable a project will be versus alternatives and is perhaps the most effective of the three methods. A capital budget is a long-term plan that frameworks the financial demands of an investment, development, or major purchase, as opposed to an operational budget that tracks revenue and expenses. A capital budget must be prepared to analyze if the long-term endeavor will be profitable. Analysis determines how different values of an independent variable affect a particular dependent variable under a given set of assumptions. In other words, sensitivity analysis studies how various sources of uncertainty in a mathematical model contribute to the model's overall uncertainty. This technique is used within specific boundaries that depend on one or more input variables. It is commonly used by financial analysts and economists and is also known as a what-if analysis. It can be used to help make predictions in the share prices of publicly traded companies or how interest rates affect bond prices. It allows for forecasting using historical or true data. The steps of sensitivity analysis is identifying potential costs and benefits that an individual or group cannot identify. For example, like a new product entering the market, advances in technology that change the market, or impacts to the supply chains. In many cases, historical data can be studied to see what impact, if any, these types of variables would have on a company's growth. In addition to historical data, decision makers can analyze qualitative variables by forming focus groups, follow markets and industries, track the life cycles of current projects and products to make assumptions to determine if the project is worth the risk of moving forward with. Decision makers are stakeholders and are often assigned to product and marketing management groups. Quantitative methods are used for decision making to ensure the highest profitability for the company. The quantitative assessment is the likelihood of some risk, and their consequences allows us to find the most probable according to their occurrence and magnitude value loss risks, which could be objects of further analysis for making decisions about project feasibility. Variables that are often considered during this step are manpower, startup costs, sales, cost of capital, working capital, tax rates, and many more. These variables are adjusted to determine the impact on the dependent variable to understand the risk that is involved. Quantitative steps measure the sensitivity of the budget to the variation of the input values and uses physical data to determine the impact on dependent variables. Incorporating risk into capital budgeting. Some reasons to perform sensitivity analysis include the need to rank the appropriate importance of input variables, to expose relationships between input and output models in complex models, to perform quality assurance and practical checks, to identify areas that need to be researched and refined in the model. It is essential to manage risk when looking at your capital budgeting. Decisions your decision makers and stakeholders make have an impact on the financial outcome of projects in the company, and the sensitivity of the budget to the changes in the variables will determine whether the risk is high or low. So it is critical to manage this risk when the company is trying to ensure profitability for the project. This concludes my training on sensitivity analysis as a tool for capital budgeting.